You got that? Let's get this, we got two.
Is it? This is on?
So how do you like living in Brea now, right? Yeah, I think about it when I go to Mother's Market. You're right next door, right?
For lunch. I'm right by Whole Foods.
Yeah, that's what I meant. I'm
Yeah.
sorry. Whole Foods, yeah. When I go to Home Foods,
I don't like that Whole Foods so much.
Oh, no?
Their produce is not that good. Yeah.
Yeah, I just go in there for like fancy stuff, like
What Trader Joe's?
I know.
I think Trader Joe's
I
is better.
Yeah, I'm sorry. I can go to the farmer's market in Irlanda. I know you know, like the French church, you know, the farmer's market.
Oh, I don't
Only reason I still want to trade that. Sorry. I'm surprised they don't burn up, but yeah, they have a farmer's market at French churches. That's pretty good.
Oh, I should look that up.
I get a lot of my produce there. But yeah, we are neighbors. Do you ever see Jenny anymore?
No, I missed her retirement. Did you go to that retirement?
Out of town too.
Yeah, yeah.
I thought you guys were living in or something.
Did she really finish? I don't know.
Oh, yeah. I thought she was a maniac.
Really?
Yeah, I thought you guys were like, that's how you know each other.
No, 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 no. No. I didn't even know she played tennis.
She did something like that. I could swear.
I mean, she does yoga. You know.
You're big into tennis, are you?
Yeah,
That's how you hurt your foot.
yeah. My knee. Yeah, but I'm getting back. So
Okay, you guys.
wait, this is.
I'm gonna turn. I have to hit the record and then I can go over.
It's recording already. It says recording right there. Recording.
Okay.
Yeah. Okay.
Sorry, you don't need me to do this too. Where's the present?
Oh.
Okay, guys, I'm super stoked to have Professor Sun here to talk about tax and employees and all the good stuff about running a business.
All right, hello everyone. I know you guys see me, I guess mostly on my video, right? Not really in person. So I'm happy to meet you guys in person. So today we're going to talk about what's the next one? If you want to start your own business, right? So if you have the entrepreneur spirit, that means, okay, I have an idea and I want to start my own business. And there's tons of things that you need to worry about, just so you know. But first of all, to be an entrepreneur, have a small business, you have to be that doer, not just the sayer. Okay, you plan, you have this idea, but you actually have to go out and do it. A lot of times, small businesses especially, you don't have the luxury of all the staff, to help you, right? So you have to do hands-on on everything. When I started my own firm, I have an accounting firm, law firm. I have to install the phone sometimes, right? I have to call a IT person to come in and get my IT set up. All those things you may have to do it yourself. Even if you call yourself the president of the company, right? It's until you grow really big, then you can have staff do some work for you. You have to be innovative, okay? You have to constantly, especially nowadays in this state of economy, you have to be able to adapt, to pivot, right? A lot of times AI is coming in and taking over some part of the task perhaps. And so you have to be able to stay on top of that innovation. Critical thinkers have to be able to solve problems right on the spot, think on your feet. Okay, these are the characteristics of running a successful business and to survive. high risk tolerance. Okay, if you have a very low risk tolerance, probably small business is not for you because you're going to be constantly worrying and you're going to stress out like crazy, right? So you have to have high risk tolerance and kind of like just when problem comes, just try to solve it one at a time. Okay, have that mentality. Be resourceful. Learn, go around and see what you have. Okay, we're going to talk a little bit more about going into the slides about this resourceful. And then lastly, to be resilient. Okay, you're going to know that you're going to run into problems every day. Okay, you just have to survive, solve the problem, and move on to the next one. All right, so you're ready? Now what? 3 key factors to consider. Okay, the first one is business structure. Okay, what's that? We're going to talk about that. The second one is the legal compliance. That's a big part. Okay, you want to make sure that you run your business legally, right? And then the third one is the tax. The big part is the tax compliance. Every business will have to pay tax unless you're running a nonprofit, right? So if you're running a for-profit business, then you have to worry about tax. All right, so the business structure, there are several kinds. I don't know if you guys learned from the business class. Sole proprietorship, that's the simplest one. Your sole means yourself, right? And this is the easiest where you don't have to register with the state. You may have to obtain a business license from the city, but you don't have to register with the state. And just because you don't register with the state doesn't mean you don't pay state taxes. Don't get that confused, okay? Both federal and state, regardless of your business structure, if you're making money, you have to pay taxes. This is just for the compliance part. You don't have to register, meaning that you don't have to be licensed by the state. That's the easiest one, and you're going to learn about when we talk about liabilities. You're going to learn about what's the downside of taking the easy route, right? The next one is the partnership. Partnership meaning more than one person. Okay, if you go into business with someone else or more than one person, then it will be a partnership. Okay, and this is another one where if it's not a limited partnership, you don't have to register with the state. Okay, you don't have to obtain a license from the state. But there's the downside to that as well. Next, I want to talk about the limited liability first before we go into the corporation. The limited liability LLC. How many here heard of LLC? One, see all that hands? Okay, everybody talks about LLC. So I get clients coming to me like, oh, I heard my friend said I should set up an LLC because I'm doing this business. It's really not for everyone. Because once you set it up, then you have an LLC, then you have this compliance obligation. Okay, you have to file these forms. We're going to get into that. If you're a sole proprietor, you don't have to do anything, right? So should you have an LLC or should you not? It depends on your risk exposure, the liability, the nature of your business. For instance, I had a kid during the pandemic, a 22-year-old friend's son, and he did well. He sells stuff on eBay and Amazon. And what does he sell? He buys these gift baskets, just small plush toys, and then he packaged them into a gift basket, and then he sells them online. And then he did really well during the pandemic. And then he heard people talking about, oh, you should have an LLC. So he came and talked to me. So I looked at his gross revenue, and given that he sells these plush toy gift baskets, his risk exposure is quite low, right? It's not like you're selling some kind of a supplement, the vitamin supplement that could potentially be harmful to the consumer's body. Those type of business might be a higher risk, right? So for him, it's a lower risk. And another part of risk is that you risk when you do sole proprietorship, everything you own is exposed, the exposure, right? That means all the assets that you own. In case there's a lawsuit, then not only that your company's money is your assets are exposed, but including what you own. If you own a house, you own a car, and those are exposed as well, right? So someone like him, he owns nothing. He lives at home. He eat off of his parents, refrigerator. So this kid had nothing, so his asset exposure is none. So then he'll have to think about, okay, I form an LLC, I have to pay all these fees, I have to file additional tax return, and should I do it? And first year in business, you're good, right? It doesn't mean that it's going to continue. So I advise him to move on to the second year to see if the business continue to grow, and then he's start accumulating his own assets. Then he may think about the LLC, and we're going to talk a little bit more about that. So that's what the limited liability company is, where it's easy as far as compliance is concerned. It's easier than the corporation. Okay, but both of these, well, you have to register with the state. And of course, the federal government as well. Okay, so if you're sole proprietor, you don't really have to register with the federal government. You just use your own social security number to file your taxes. But for LLCs and corporations, you have to register with the state, and then you also have to register with the IRS as well. All right. Okay, so then you ask, okay, how do I pick between LLC or corporation? LLC tend to be for smaller businesses. Okay, you're just going in either by yourself or with some partners, and you want that limited liability. That means the liability protection. Then you will go into LLC, especially if you're not looking for outside funding. Okay, if you're looking for investment to attract investors, then that's where you're going to look for corporations. Corporations, usually you could attract investors better, but it has more cumbersome for compliance. Okay, more paperwork to keep up. That's the downside of it. Otherwise, if you have a corporation and you're looking for, I have this brilliant idea, I'm going to start it, and then I'm going to go out and seek for investment from outside source. Okay, and that's why you want to think about, okay, maybe I don't want to be an LLC that's limited to just the initial investors, and I might want to consider corporation. And corporation, and you guys heard about S Corp? What is the difference? Anybody know?
If you make your incomes over 50, it's additional tax.
Why is that? Where did you learn that?
Oh, my husband told me he's a
Well, so legally, it's just corporation. There's no S Corp or corporation, a C Corp. On the legal side, it's just corporation. S Corp is for tax purposes. It's a tax classification where you're going to file tax as a C Corp or S Corp. But legally, it's just one corporation. There's no C Corp or S Corp. Okay, that's the difference. And we're going to go into what is the difference filing C Corp versus S Corp. What's the pros and cons? All right. Okay, let's move on. So the legal compliance, sole proprietorship, as we said, that nothing needs to be done. The city may require a permit or business license, and the nature of your business. Earlier, I don't know if you guys heard the earlier presentation on the food industry, right? There's plenty of permits that you need to get, all that. But as far as the business structure, you don't need to do anything. You don't need to register with the state or register with the IRS. Now for LLCs and corporations, you can see right here, you need to form, meaning that you need to register with the state. You file forms. For corporations, you have the annual filing of what is called the SOI, which is the Statement of Information. But initially, the formation requires articles of incorporation and that initial SOI. And you also should have your bylaws. that bylaws governs the operation within the corporation and the corporate minutes. Okay, you see all of these paperwork, right? And then the LLC, the formation, kind of similar to a corporation is articles of organization, just a different name, but the same type of form, and the initial SOI. And instead of bylaws, you may have an operating agreement. Now that's optional. It depends. I mean, typically you're operating by yourself. You don't have to have an agreement with yourself, right? But operating agreement is recommended when you have more than one person in the LLC. And then, so both type of entity will have to file federal and state tax returns. Okay, federal and state tax returns. And GP is general partnership. Typically has a written agreement called partnership agreement. And general partnership does not, kind of like the sole proprietorship, does not require any filings with the state unless you are forming a limited liability partnership. Okay, this LLP is popular for law firms, LLPs. All right, so after you form, you guys heard of LegalZoom.com? Doing a lot of advertising, marketing. Click of a button, then you can form your company, right? And forming a company is super easy. These forms that I'm talking about, it's like a one-page form, right? So a lot of people would just go there and do it on their own, or go LegalZoom probably charge like $100 or something, very low fees. They don't talk about, okay, you have you form a business entity, and what happens when you decide to close? You stop doing business. If you're a sole proprietor, you just close up shop and done, right? But if you have a business entity, it's not that easy. I have clients coming to me and said, I got this bill over $5,000 from the FTB for this company that I formed like 8 years ago. I never even did business. Why are they charging me this fee? Why? Because you have to tell them that you're no longer doing business. Okay, you don't tell them, they're going to assume that you're continuing to do business. Now, the fees, before we get into it, I just want to tell you right now, for these corporations, LLC, you form in California, even if you do $0 business, they want $800 from you, annual fee, regardless of your business activity. They don't care. Okay, so that fee is not based on your income that you reported. All right, so keep that in mind. So if you formed the business for 8 years, you didn't tell the California that, hey, you're not no longer running the business, they're going to charge you $800 times 800 times 8 years, plus penalties for not filing returns and not paying that fee. Okay, so that's why it all adds up, right? So take note that you have to file go through the process called dissolution. You have to file a couple of forms and with the state and tell them that, okay, I'm dissolving this business entity. That's how you end it. So I guess one advantage for sole proprietorship and partnership, where you don't register with the state, you can just close and nobody cares. Okay, does that make sense? All right. So legal considerations about the liabilities. Sole proprietor, unfortunately, everything is exposed. As I said earlier, if you get into a lawsuit, they first will look into your business account. Sole proprietor could still have a business account. They could have a Linda Sung doing business as ABC company, right? And so in case of a lawsuit, then they'll be suing Linda Sung, DBA, ABC company. And then they'll first go after my business account. If my business account has no money, then they will look into my personal assets to see what I own. And then they'll go after that. Okay, so sole proprietorship, no protection whatsoever. That's where the LLC and corporation comes in, where it's limited liability. Limited to what? Okay, so LLC, if you put in $5,000 to start the business, right? So whatever money that's in your business account, that's exposed. Whatever assets that the LLC owns, that's exposed. Okay, so I don't know if you guys, anyone knows anyone owns a bunch of rental properties and receive advice where, oh, you should probably, form LLC to hold these rental properties. And I get questions from clients all the time, like, oh, I have 10 properties, so how many LLCs should I form? Okay, that's a very good question, right? And the answer is depends. If you want separate so remember the exposure is what the LLC owns, right? So if LLC 1 owns 5 properties, that means the exposure is all 5 properties. If you put LLC 1 owns 1 property, then exposure is limited to that, just 1, right? But that means you have to form 10 LLCs to hold, right? 1 each. And that could be costly too in fees in filing these returns. So you really have to see what that risk exposure is, right? So if you own typically single residence is less risky than apartments, right? Multi-residence. So you have to, and then the location also comes in play too. So if it's located in a nice location, that will be considered low risk. And you can group those maybe 3 with a low risk together in 1 LLC, and that will be the exposure. Okay, so there's no one size fits all answer to that. You just have to look at what is the portfolio looks like. Okay. All right. Partnership is kind of like the same thing as sole proprietorship. There's no protection. And I always think that partnership is even more risky than sole proprietorship because when you run a business by yourself, right, you're responsible for your own actions. When you're partnering with somebody, your partner can cause you trouble, right? I had a client that came to me and his partner went out and got a loan on behalf of the partnership without his knowledge. So got a second loan on the commercial property they own. Okay, so his partner backed out maybe 2-3 years in. And then so when he's trying to sell the property, he realized that he can't sell it until he pays off that $50,000 loan, whatever that his partner got. Okay, so his partner borrowed against the property without his knowledge because he's a partner of the partnership. He was able to do that. Okay, so partnership in that sense is even more dangerous than, running the business on your own because you know what you're doing, right? So you'll be responsible for yourself, but partnership, you'll be also responsible for your partner's action as well. Okay. All right, now we're into tax compliance. Do you guys need a drink of water? It might be. I'm gonna try to make it as fun as possible, but it could be. So when you guys think of tax, and we just did the tax clinic today, right? It's all about income tax, right? You file the individual income tax. That's one. And as a business, the C Corp, the corporations and the LLC will have to file their business, what's called business return. That's separate from the personal, right? So there's income tax. And income tax, of course, has state and federal. Okay, state and federal. Unless you're in a state where, like, the state of Washington has no personal income tax, right? The state of Wyoming has no business tax. So if you have a business in Wyoming, you don't have to pay the state taxes because they don't have business tax. Okay, but all business and individuals will have to pay federal tax. There's no exemption on that. Okay. And self-employment tax is another one. A lot of people, especially sole proprietorship, you think, okay, my business made very little money, right? And then you guys learn about the tax, for the standard deduction for one single filer is how much? Anybody remember? It's around 15,000. Okay, a little bit over 15,000. This new 2025. So if your Schedule C business made $10,000, so income tax, you don't owe anything because the standard deduction will offset against that. So income tax, you owe zero. So a lot of people after they get the tax return, I only made 10,000, which is lower than the standard deduction. How come I owe? Why? Because self-employment tax. So what is self-employment tax? How many people here work? You get a W-2 with, right? So if your gross income from your W-2 job is 1,000, do you get 1,000 in your paycheck? No, you get a net pay, right? That's because you pay into your Social Security and Medicare, right? Even if you don't withhold any income tax, you have to pay that. So self-employment tax is that. So you pay as an employee, you pay 7.65%. You as a self-employed, that means you play two roles. You are employer and employee. And because of that, you pay 7.65 times 2 because you're an owner. If you work for someone, your employer pays 7.65 on your behalf. Okay, so the employer matches whatever you pay in. And if you're self-employed, you pay both. You play both roles, so you pay 15.3. All right, so in that scenario I just gave you guys, right? You don't owe income tax, but you still owe self-employment tax. So beware of that.
Will that be after the net profit of the business?
Yes.
It is, right?
Yes.
So if you
Oh.
have a loss, then you don't pay.
Right.
Self-employment tax?
Yeah. So I'm talking about $10,000 net profit.
Oh.
Yeah, after it. Yeah, very good question. So taxable income, that's what we call it. All right. Okay. Next thing, sales tax. If you sell goods, okay, you have to pay sales tax. Well, you don't pay the sales tax. You collect from your customers, and then you have to, on the behalf of the tax agency, and then you have to pay them, right? So here in California is the CDTFA. That's right here, the long name, CDTFA. And you have to register with them, get what is called a seller's permit. Remember, once you register, even if you did no business, you still have to file the tax return. Otherwise, they're going to assume that you failed to file. Okay, of course, you didn't collect any sales tax, then the tax return will be zero. But that's still the procedure. You have to file. If you don't file, then you're subject to penalties. Okay, so be careful when you register with the CDTFA. When you're ready, then you register. Okay, don't register too early and then forget to file. You have to file at least a quarterly return. CDTFA of you guys know all the tax agencies. So income tax, here California is called the Franchise Tax Board, the FTB. Everybody, of course, knows the IRS, right? We got the CDTFA, and then the next one is the EDD. Of all of these tax agencies, who is the meanest? Oh, IRS compared to all the IRS are angels, okay? Yeah, so the CDTFA is the meanest. They would, if you run a business, especially food and beverage, they'll come and sit at your restaurant for a week and just see how much business you have. Okay? Yeah. So, and then based on that, they will hit you with a tax bill, and it's your burden to disprove them. Okay, so they are very mean. So be careful when you deal with the CDTFA. I have several cases with them that I have a client, a big guy, tall guy, 6'2" guy, crying in front of me that he felt like he was harassed by the CDTFA. Okay, so make sure, think twice before you register that you're ready to go, and then you register with them. All right, so the final one here is the EDD. So if you have employees, then you have to file with the EDD. You also, of course, have to file with the federal government and get that EIN, the employer identification number, the EIN. Okay, so this is another thing that even once you register, even if you have no employee for the quarter, you still have to file a zero report. You don't file, then you have a failure to file. Okay, make sure you know that. And also be cognizant of this workers' compensation. If you have employees, you have to have this insurance. Okay, you have to buy the insurance. All right, now we get to the tax classification. So I need you guys to distinguish between the legal side, right? So you have LLC, especially LLC. Corporation legally is corporation. For the tax classification, as we said, it could be a C corp, or it could be an what is called an S corp, the small corporation. Okay, small corporation is what is called the income. If you're a C corp, you file a C corp return, and the income and tax is paid at that level. Okay, the taxes is paid at the C corp level. S corp is what is called a flow through. That means you file this return, but that income, you don't pay tax on it with the S corp return. It flows through to the owners. Okay, so for corporations, the owners are called what? What are the owners? Shareholders, right? If you own one share of Apple, you're owner of Apple, as we said in the accounting class, right? So the shareholders' return will get that income. So let's say the two of you, you're 50-50 owner of ABC Corporation, and the corporation made $50,000, right? So each one of you will get an information form called K1 and reports that 25,000 to you, 25,000 to you, and you are responsible to file that on your own personal return. Okay, that's how it works. And that's what this flow through means. That means the return, the income, and is not taxed at that business entity level. It's taxed on the individual's return. Limited liability company has this one big pro here. It has different classification at the discretion of the owners, how they want to pay tax. Okay, so single members by default is what is called a disregarded entity, meaning that for tax purposes, you're not a business entity. You just file your income and loss on a Schedule C, on your personal return, just like a sole proprietorship. Okay, but legally you are LLC. So don't get that confused. Sometimes I get clients that, oh, if I report my income on the Schedule C, do I lose the limited liability? No. Legally, you are an LLC. This is just a tax classification. For tax purposes, you are allowed to file as a disregarded entity. And that makes it simple because this is only on federal side, okay? Federally, you can do this, so you don't have to file a separate business return. You just file on your Schedule C. So that saves money, right? But on the state side, unfortunately, California, how much do you have to pay for LLC annual fee? $800. They want their money. So they don't allow you to just report on a Schedule C. They want you to file a separate business return so you can pay that $800. Okay, so that is required. Multi-member has a choice of filing a partnership return. Okay, multi-member. So partnership return, kind of just like this one. The partnership return, it's a business return, but the income flows through to the owners. So by the way, the LLC, the owners are not called shareholders, but they are called members. Okay, members. So the multi-members, they can file a partnership return if they want to. And lastly, they may elect to be taxed as a C corp. So that gives this LLC this advantage, right? Because when we go to the C corp, you're going to learn about there's some disadvantage of filing as a C corp. Okay, so they have a choice. They could start out as just doing a disregarded, and then they elect to be C corp, or they can do an S corp also. Okay, just have to follow the procedure. They have to make this election as a C corp and make another election to be treated as an S corp. Okay, so there's multi forms to be filed if you want to go that route. And we're going to talk about, what kind of situations will this be suitable. Okay, so flow through entity first. The owners, not the entity, as I said, it flows through to the owner's return, right? And every owner is going to get a K1. So whether you're an LLC or an S corp, if you file that return, then you're going to get a K1, and that K1 reports the income. And if you take the income tax class, and you're going to know that there are different types of income, and it could be taxed differently. So ordinary income is taxed at an ordinary rate, but capital gains or dividends, qualified dividends could be taxed at a lower rate. Okay, so on that K1, it's going to distinguish what type of income it is. All right, so corporations pays tax at entity level. And you heard about corporations. Anybody ever heard of a double taxation, the term? What is that? Anybody know?
When kind of income from school, maybe individual.
Well, actually, if it's S corp, it's only one tax, one time. It's
Income was taxes by the business, and the net income is shared to, like, the dividends to the shareholders. Do the shareholder need to pay tax in the individual?
yes, that is correct, but it's not S corp. It's C corp. Yeah, C corp. That's where it is. C corp, you pay the entity level, right? So C corp is treated like a separate. It's almost like a separate person. It's just not a natural person. So it's completely separate. Everything that owns is all belongs to the corporation. So the corporation wants to reward the shareholders, then that they pay what is called dividends, right? They declare dividends. So the shareholders will pay a second level tax, as you said, when they receive dividends. Okay, that's why it's double taxation. The same income kind of get taxed twice. You pay at the entity level and then the individual level again, right? So you might want to ask, why would I want to be taxed as C corp? So just hold that thought. The taxation for flow through, the tax reform in 2018 dramatically lowered the C corp tax rate. Okay, and then so the flow through entities are complaining. What do we get? Okay, C corp gets this lower rate. What do we get? And this is what they get. Okay, so the flow through entities get what is called a QBI deduction. So if you made $10,000, you reduce it by 20% before it flows through. So earlier that scenario, right? The $50,000, so it gets reduced down to 40,000, the taxable income, and then you each just pay tax on the $20,000. Okay, that's what this QBI is. And it was originally set to sunset at the end of last year, but because of the big beautiful bill, the BBB, it's now made permanent, the QBI. Okay, so it's good news for small businesses. Okay. All right, so the individual rate. So these flow through, right? The rate flows onto the owner's return, the shareholders or the members. How much do you pay? It could be anywhere from 10 to 37%. Okay, 10 to 37%. Of course, if you're lower bracket, then you don't have any concern. This is great. If I do S corp, if I do the LLC, disregard it. I don't have to file additional business return. That saves me money, unless you file yourself. If you pay someone to file business returns, the fees can be high, right? But in addition to this, we talk about the 15.3. So if you're an LLC, that's earned income. It's same thing as the self-employment tax we talked about earlier, that it will be subject to the 15.3. Okay, in addition to that, if you have any investment income, it could be subject to additional 3.8%. You see, all that adds up, right? Now, if you look at S corp income flowing through from S Corp is not subject to self-employment tax. Just know that. And that's one of the advantage earlier. I think you said that your husband said the S Corp is better, right? For 50,000 or more. They could be talking about that. That is not subject to self-employment tax, which is good. Look at the corporation, the C Corp rate. Earlier, we just saw 10% to 37, right? C Corp, whether you have $1 or you have $1 million in income, it's a flat 21. So that kind of makes you think. If you're running a business, it's LLC initially, right? And then you were at a 15% bracket, let's say. Okay, so it makes sense. You don't want to be C Corp because it's 15 versus 21. But once you get to a 30, I have a lot of clients in 35, 37% bracket, then they may really want to think hard about, okay, I might want to convert my entity, the classification to a C Corp, to be taxed as C Corp. Okay? But downside, like we discussed earlier, if you're a C Corp, it's subject to double taxation. So you have to be able to how to kind of manipulate the system, if you will, that money that's sitting in the C Corp, you can continue to use it for other investments. It doesn't mean you can't use it. You don't have to take it out as dividends. Once you take it out as dividends, then you have to pay at that additional level of tax, right? If you keep it in there and continue to use it to make money, then you don't. But meanwhile, you are only subject to the 21%. Okay, so that's the difference between, okay, what to choose. What's the classification? And LLC, if you're a corporation, you really can't choose. It's either S Corp or C Corp. But if it's LLC, then you can, have more options. All right, so next we're going to talk about owner compensation. So this particularly relates to S Corp. Sole proprietorship, you don't have to pay yourself. Whatever income's made, it's considered your compensation. Okay, we're talking about S Corp. S Corp, because it's not subject to self-employment tax, a lot of S Corps, they don't pay themselves, the owners. Because I'm a CPA, I form an S Corp, right? And I don't pay myself. I'm the one who's running the company. But I don't pay myself anything. I let the income flow through to avoid self-employment tax, right? The IRS is going to ask who's running the company. You have no employees. You have all these income flowing through. Who's running the company? So they may pick up this return for audit because of that. That's one of the biggest abuse area for S Corps. A lot of S Corp, they don't pay themselves. The owners don't pay themselves for working in the S Corp to avoid self-employment tax. Sorry?
I think you are required.
You are required, but a lot of S Corps don't. They let the income flow through to avoid self-employment tax. Okay, so that's what I'm talking about here. That S Corps and C Corps, they need to pay. If you work in the corporation, you have to pay yourself. How much do you pay? You pay whatever is the going rate. Okay, whatever. Yeah. Okay, so this is one thing that we talked about earlier. That the corporation, should I pick disregarded entity or a C Corp? We talk about maybe the tax rate difference. Another big concern is here. Normally, anybody here ever started a new business? Did you start making money right off the bat? Okay, that's very normal, right? Normally, small businesses, you expect to lose money. So when you lose money, you want to use the losses to offset against your other income you have in it, right? If you're a C Corp is, as I said, is a separate entity. It's completely separate from you. So if you have a C Corp classification and you lose money, it just gets trapped in the C Corp until your C Corp makes money. Because it doesn't flow through. It's not going to benefit you. Okay, that's why when you make these decisions, what classification to choose, especially LLC, because you have all that options, right? You have to look at where you stand. Okay, I was talking to a client who's she said that she's doing a chain restaurant, and then she just bought a chain restaurant, something like that. And what should she choose? So I said, okay, if you're a new restaurant, then you probably expect to lose money. You probably don't want to be a C corp. And then she said, oh no, I'm leasing. So it turns out that she owns the strip mall. She's leasing it to a restaurant. Okay, then and she said I'm definitely gonna make money. So that kind of like changes the whole picture, right? The decision making. So these are the things to think about. All right, so now we're kind of through the tax side. The bookkeeping. All right, you run a business. How many people here took a bookkeeping class? Accounting? Accounting, okay. Yeah, so a lot of my clients, I mean, I understand small businesses, I mean, your focus is trying to make money, right? To make a profit. So bookkeeping is the back end. It's probably the last thing on their mind until it matters. Okay, so a prime example is during the pandemic. You guys remember the pandemic? Okay, government is handing out a lot of subsidies, but they don't just hand it out to anybody, right? You have to be able to show that your business, whether it's making money, you're not losing money, and all that. And that's where the bookkeeping comes in, right? And I have clients that have no books per se. For tax filing purposes, if you get audited, that's what the first thing the auditor will ask for is your bookkeeping records. And for operation purposes, a lot of people kind of overlook this. You need the books, the financial data to tell you where you're at. And what changes can you make to make your business better? Okay, so it helps with your operation side as well. And then financing purposes. If you grow to a certain point, you probably don't want to continue to use your own money. You have the leverage to borrow, right? Let's say you have the leverage to borrow at 6%. And do you want to risk your own money? Right? If you can borrow at 6% and you know that your rate of return is going to be definitely higher than that, then use the bank's money, right? That's financing. So financing, of course, requires a set of books as well. All right. So if you're really thinking about running your own business, a lot of small businesses probably don't have the funds to the budget to hire a professional, right? But learn it yourself. It's not that difficult if you put your mind to it, right? So it's good to know what to do before, and you get too busy, then you have the budget and you hire a bookkeeper. Okay, so this is very important, and we of course offer accounting and bookkeeping courses at SAC. Okay, I think there were some questions about. I think you said someone was interested in the ITIN, right? So ITIN is for people who don't have SSN and want a tax ID number. IRS doesn't just hand out ID numbers to anybody, only if you have the needs, right? So the first thing is that, hey, I don't have a social security number, but I want to pay taxes. IRS likes that. Okay, you want to pay taxes? Okay. Okay, we'll definitely give you an ITIN. So that would be the number one. So how do you get it? One way is option one is you complete this form called W7 and then you mail it here. You mail it to this address. You have to, of course, prove your identity. And then so they have these options. The most common one is your passport, right? Wherever your nationality is, you have passport, then you'll have to send in, unfortunately, you need to send in the original. They don't take copies. Okay, so a lot of people don't like to do that. And so you might turn into option two, where you go to what is called a certifying acceptance agent. Okay, you can just Google certifying acceptance agent, and then you could probably go to that company directly in person. This way, you don't have to send your passport, just risk of losing it. Or right here in Santa Ana, we have the IRS office here. Okay, make an appointment with the IRS office, and then apply in person. There. Okay, 3 options. Any question on this? Yes.
If a person is out of the country, can you assign someone to get the IT for the person?
Yeah, if that person's out of the country, then you will need that person's passport. You have to use option 1.
So he
Mail it in.
needs to assign someone, let's say if we sign.
Yeah.
He needs to mail the passport.
Yes. Yeah. All right. And how long does it take? I think it says the IRS website says within 7 weeks, but I wouldn't hold my breath. Okay, IRS is they're pretty busy. So yeah, I think expect probably 7 to 14 weeks. Yeah, double that. Okay. And then you can call for help. And these are the numbers that in case you want to call. You can Google all these information online, by the way. And that's the end. Any questions? Yes.
Me, but for the IT number, it's only for people who wants to do the tax return.
You have to have the need to have an ITIN. So the most common reason is that you want to file your taxes.
But they give the IT if they don't. I'm asking because I have my 401 and I have no family here, so I want the IT for my mom, but my mom don't live here.
Your mom, so why do you need an ITIN for your mom?
Because I need to the beneficiary of my 401 and I need the IT or the social.
Oh, you need to put her as your beneficiary on your, okay, you could use that as an example. I mean, a reason.
Yeah.
Yeah. Another common reason is when you have kids that you need to put on the tax return to claim as dependents. That's another common reason for an ITIN as well. It's all part of the tax return process. Yeah. Okay.
If you have, for me, I have clients, in China, they purchase a house here.
Mm-hmm.
Some management property. So they need to get an ID.
Mm-hmm. Yeah, but they own properties here. Definitely. IRS is looking for money out of the person. That's usually the premise. Any other question? Yes. I think there's probably a small fee, not a large fee. Yeah.
And it's a one-time thing or
It's a one-time thing. You may have to renew it. I think you need to renew it. Renew the ITIN after 2 years or something. Yeah. It's not permanent. Yeah.
it's free for you.
No, it's always a fee. Yeah. Because nothing's free. Unfortunately. All right, any other questions? All right, guys, thank you for staying. All right. Okay, so I think this is yours.
I want to grab those
Oh,
videos.
yes.
Can I answer?
Yeah.
Okay.